You use Apple products every day. You made Apple rich, but Apple never paid you back because you never owned a piece. The people who did? $10 in 2010 is $220 today. Same company you gave money to anyway. 3 myths about stocks. 1. It's gambling. 2. It's for rich people. 3. It's too complicated. All 3 wrong. All 3 keeping you poor. One sentence. A stock is a legal ownership right in a real business. That's it. When Apple earns money, you earn money. When Apple grows, you grow. You're not betting on a number. You own something real. 1976, a garage in California. 2 guys. $1,300. One idea. Computer for everyone. That garage became the most valuable company in human history. $3.4 trillion. Company grows, needs money. 2 options. Bank loan. Borrow and repay with interest. Or sell pieces of the company. Give investors ownership. Get cash to grow. Apple chose option 2. So did Amazon, Google, Tesla. 1980. Apple goes public. 4.6 million shares created. Price, $22 each. Day 1. Steve Jobs worth $256 million. Early investors, 100 times their money. IPO, the day the public gets to own a piece. Today, Apple has 15 billion shares. 1 share, $220. Buy 1, you own 0.000000065% of Apple. Sounds ridiculous, but Apple earns $97 billion a year. Your 0.000000065%, $6.30 in annual profit, working for you. Every year, why does a stock price change? Supply and demand. More people want it. Price goes up. More people sell it. Price goes down. Every second. Every day. 52 million trades on NYSE daily. Each one moves the price. But what drives buyers and sellers? Profits. Apple 2010, $14 billion profit. Stock $10. Apple 2024, $97 billion profit. Stock $220. Profit grew 7 times. Stock grew 22 times. Market pays a premium for future growth expectations. P/E ratio, 3 seconds. Price divided by earnings per share. Apple, P/E, 30. You pay $30 for every $1 Apple earns. High P/E. Market expects big growth. Low P/E. Mature or struggling company. One number. Tells you everything. When price disconnects from value. GameStop, January 2021. Revenue, $5 billion. Declining. Profits, near zero. Stock, up 2,400% in 2 weeks. Reddit versus hedge funds, pure speculation. No business behind it. Ended exactly how it always ends. Company earns profit. 2 choices. Reinvest, build more products, hire, expand, or pay shareholders directly. That payment is a dividend. Money deposited into your account for doing absolutely nothing. Coca-Cola, 61 years of dividends, never missed one payment. Through recessions, through 2008, through COVID, $1,000 invested in 1962, worth $650,000 today. Dividends alone, $89,000, paid out while you slept. Growth stocks versus dividend stocks. Apple reinvests everything. Stock plus 2,100%. Coca-Cola pays dividends. Steady income. Young investor. Growth. Time is your asset. Near retirement. Dividends. Income without selling. Age determines strategy. Common versus preferred shares. Common. You vote. You risk more. Preferred. Guaranteed dividends. No vote. Company goes bankrupt. Preferred shareholders paid first. Common shareholders get what's left. Usually nothing. Most people own common. That's fine. Growth versus value stocks. Growth. Tesla, Nvidia, Amazon. Fast expanding. High risk, high reward. Value. Coca-Cola, Johnson & Johnson. Slow steady. Lower risk. Consistent. Neither is better. Depends on your timeline and stomach. Large cap versus small cap. Apple, $3.4 trillion. Large cap. Stable. Predictable. Slower growth. Random biotech startup, $800 million. Small cap. Could 10 times in 2 years. Could go to zero next month. Index fund covers both automatically. You don't choose. Market decides. Ticker symbol. Every public company has one. AAPL is Apple. GOOGL is Alphabet. TSLA is Tesla. MSFT is Microsoft. 4 letters. 1 company. Your entry point to ownership. 5 numbers on every stock page. Current price, what market pays now. 52-week high and low, the range. Market cap, total company value. Volume, how many shares traded today. P/E ratio, expensive or cheap. 5 numbers. Complete picture. Market cap, simplified. Stock price times total shares. Apple, $220 times 15 billion shares. $3.4 trillion. More than Germany's entire GDP. More than France and UK combined. 1 company. Built from a $1,300 garage. 5,000 stocks to choose from. Which one do you pick? 80% of professional fund managers get it wrong every year. With decades of research, with billion-dollar teams, with full-time analysts, they still lose to the index. Index fund owns everything at once. VOO, you buy 1 share, you own Apple, Amazon, Microsoft, Google, Tesla, Nvidia. 500 companies. 1 purchase. Apple crashes. Amazon compensates. Amazon crashes. Microsoft compensates. Automatic protection. 0 effort. The fee difference destroys wealth. Active fund. 1.5% annual fee. Index fund. 0.03% annual fee. Sounds tiny. On $100,000 over 30 years, active fund costs $180,000 in fees. Index fund costs $3,600 in fees. $176,400 difference. From a number after a decimal point, simplest portfolio in the world. 1 ETF, VOO, or VTI. Automate monthly contribution. Never sell during crashes. Check once per quarter. That's it. Outperforms 80% of professionals. Requires 0 expertise. Apple, 2010. $10 per share. Everyone said too expensive. P/E ratio too high. Growth priced in already. Wait for a dip. 2024. $220. The people who waited for the dip are still waiting. 3 things, that's all. Stock equals ownership in a real business. Business grows, stock grows. Buy the index, buy all businesses. Everything else is noise. Start with 1 share. Today, meet Bob, worst market timer in history. Invested only at market peaks. 1972, 1987, 2000, 2007. Every single time, right before crash. Never sold. 2023, $1,100,000. From $184,000 invested. Even the worst timing wins if you never sell. 3 steps, 10 minutes. Open Fidelity or Vanguard account. Search VOO or VTI. Buy 1 share or $1. Set up automatic monthly transfer. Done. You are now a shareholder in 500 American companies. 6 videos in, you understand inflation, compound interest, the salary trap, debt, market crashes, and now stocks. Most people spend a lifetime not knowing this. Next, why 99% never build wealth. Not math, pure psychology. Subscribe. You're close to the finish line.